Picture two people, both 63 years old, both retired early, both buying health insurance through the ACA marketplace. Both got a nice monthly subsidy, call it $800 a month, knocking their premiums down to something manageable. The difference is this: one of them did a Roth conversion in October without running the income numbers first. Come April, she owes the IRS $9,600. The other guy owes nothing extra. Same age, same health plan, completely different tax bill, because of one move that nobody warned her about. According to the Kaiser Family Foundation, more than 3.8 million Americans between 60 and 64 were enrolled in ACA marketplace coverage as of 2024. A lot of those people are also doing Roth conversions, which on paper sounds like smart retirement planning. But if you don't know exactly how the IRS counts that conversion income, you can wipe out an entire year of subsidy savings in one filing. So let's slow this down and really look at what's happening. Because the mechanics here are not complicated, but they are genuinely counterintuitive. And I'd be willing to bet most financial content you've seen skips straight to the strategy without explaining why the trap exists in the first place. The way ACA premium tax credits work is deceptively simple on the surface. You go to the marketplace, you estimate your income for the year, and the government advances you a tax credit every month to offset your premium. It pays your insurer directly. You pay the leftover. That monthly discount, formerly called the Advance Premium Tax Credit, or APTC, is calculated based on the income number you gave when you enrolled. The operative number isn't your gross income, it's your modified adjusted gross income, what the IRS calls MAGI. For ACA purposes, that's your adjusted gross income plus a few add-backs, tax-exempt interest, non-taxed Social Security, things like that. Here's where the eligibility cliff matters. In 2026, to qualify for any premium tax credit, your MAGI has to fall below 400% of the federal poverty level. For a single person, that's roughly $62,760. For a married couple filing jointly, it's around $84,920. CMS publishes these thresholds each year, and they adjust with the poverty guidelines. Now, one critical detail. Because of extensions originally tied to the American Rescue Plan, income above 400% FPL doesn't automatically mean zero subsidy, but it does mean you start repaying dollars fast, and there is a hard cap on how much the IRS will forgive. More on that cap in a minute. The subsidy itself is sized to keep your benchmark plan premium at a specific percentage of your income, sliding from about 2% of income at the low end up to around 8.5% at the top of the eligibility range. So if your income goes up mid-year, your required contribution goes up, and the credit you were advanced goes down. The government settles that difference at tax time using Form 8D-8962. That reconciliation is where people get blindsided. Now here's the part that genuinely surprises people. And I've talked to folks who've been doing this for years and still didn't fully get it. When you convert money from a traditional IRA to a Roth IRA, every dollar you convert is treated as ordinary taxable income in the year of conversion. The IRS isn't wrong about this. That money was pre-taxed when it went in. It was always going to be taxed at some point. The conversion is just choosing when. But the timing has consequences that go well beyond your income tax bracket because that conversion income hits your MAGI. All of it. A $30,000 conversion in October doesn't just mean you owe income tax on $30,000. It means your MAGI for the whole year just jumped by $30,000. And if that jump pushed you over the income level your premium tax credit was based on, you will repay some or all of those advance credits when you file. Not a penalty, not a mistake. A legitimate reconciliation that the IRS is completely entitled to. That's what makes it feel so unfair. You followed the rules. You just didn't know how two separate sets of rules, tax law and healthcare subsidy law, interact. Let me put a number on it so it's concrete. Say you're 63, single, and your retirement income in 2026 consists of $28,000 in Social Security, of which roughly 85% is taxable, so about $23,800 hits your MAGI, plus $10,000 from a small pension. That puts your MAGI around $33,800, well below the single filer 400% FPL threshold of about $62,760. Your advance premium tax credit is substantial, potentially $700 to $900 a month, depending on your state and plan, based on typical 2026 benchmark silver plan premiums tracked by KFF. So you're getting, say, $9,600 in advance credits over the year. Then in October, you decide to do a $35,000 Roth conversion. Smart move in isolation, you're filling up the 22% bracket, reducing future required minimum distributions, getting more money into tax-free growth, all legitimate goals. But that $35,000 lands on top of your existing $33,800 MAGI, pushing you to $68,800. You've now crossed the 400% FPL line. At $68,800, you don't qualify for the same credit you were advanced. The IRS runs the reconciliation on Form 8962, and the result is a repayment, potentially the full $9,600 you received in one tax filing. Now, there is a repayment cap. And this is the one piece of good news in this story. If your income ends up between 100% and 400% of FPL, the IRS caps how much you have to repay. For 2026, the cap for a single filer tops out at $1,650 if you're below 300% FPL, and $3,400 if you end between 300% and 400% FPL, based on IRS Revenue Procedure 2025-13, which sets these limits annually. But, and this is the part that matters, if your income exceeds 400% of FPL, the repayment cap disappears entirely. You owe back every dollar you were advanced. No ceiling. That's the cliff. Cross it by $1 and you're on the hook for the full amount. This is why I honestly think the 400% FPL line is one of the most dangerous thresholds in the entire tax code for people in this specific age window, 62 to 64, before Medicare kicks in at 65. You're dependent on the marketplace. Subsidies are large because benchmark premiums are high for this age group. A 63-year-old can pay $1,000 or more per month for a silver plan before credits, and a Roth conversion can knock you over the line without you ever seeing it coming. Crossing that cliff costs more than the conversion saves in many cases. I've seen people net negative on a conversion because of this exact interaction. The right move here is to convert with your MAGI ceiling in mind, and calculate that ceiling before you convert a single dollar, not after. I cover catch-up retirement strategy for late starters, and this is the scenario where I see the most avoidable damage. Here's what I'd do. Figure out your projected MAGI from all non-conversion sources first: Social Security income, pension, part-time work, dividends, capital gains distributions, all of it. Then calculate how much room you have under the 400% FPL line. In 2026, for a single person, that's the $62,760 figure from CMS. Convert only up to that ceiling. If your other income already puts you close to the line, convert less, or skip that year entirely and wait until January to reassess. One more piece of individual variation that changes the math meaningfully. If you're married filing jointly, the 400% FPL threshold is higher, about $84,920 for 2026. But your combined MAGI from 2 Social Security benefits, pensions, or part-time income can also be much higher. Don't assume you have more room than you do. Run the actual numbers with your actual income sources. And if you have a spouse who's still working, that income alone may have already pushed you close to the threshold before you consider any conversion at all. There's also a smarter sequencing strategy worth understanding. Some people in this window, 62 to 64, actually do their heaviest Roth conversions in years when their income is lowest. Maybe that's the first year or two of early retirement, before Social Security starts, before a pension kicks in, before part-time work picks back up. If your MAGI in those years is, say, $28,000 as a single filer, you might have $34,000 of room under the 400% FPL threshold. That's real conversion capacity. Use it deliberately. A tax professional who works with ACA clients, and I'd specifically look for one who lists ACA planning as a specialty, can model this out for you in an hour and potentially save you thousands. One thing that trips people up: you can update your income estimate with the marketplace mid-year. If you've already done a conversion and you know it's pushed your income up, you can report the change to healthcare.gov or your state exchange. That won't undo the reconciliation entirely, but it will reduce the advance credit going forward for the rest of the year, which at least shrinks the gap you have to repay at filing. It doesn't fix the problem retroactively. The IRS still settles the whole year on Form 8962, but updating sooner rather than later is better than doing nothing. The last thing I want to say on this is something I see get glossed over constantly. People get sold on Roth conversions as this universally smart move, and they can be. But the financial content machine tends to talk about them in isolation, as if your tax return exists in a vacuum. It doesn't. Your MAGI is the thread that connects your income taxes, your ACA subsidy, your Medicare premium surcharges once you hit 65, your Social Security taxability calculation, all of it. A move that looks optimal on one line of your return can quietly cost you on 3 others. That's not an argument against Roth conversions. It's an argument for doing them with full visibility into the whole picture, not just the bracket math. I'm not a licensed financial advisor. This is general education, not personalized advice. Consult a fiduciary before acting. If this filled a gap that other content left open, subscribe to Money After 50. I put out 1 video a week, specifically for people who are building a real retirement plan from wherever they're starting right now. Drop a comment below with any specific topic you'd like me to dig into next, whether it's IRMAA surcharges, Social Security timing, or anything else on your mind. I read them and work the best questions into upcoming videos. Next week, I'm covering survivor benefits, specifically the permanent reduction schedule that applies at different claiming ages, and when it actually makes sense to switch from a survivor benefit to your own retirement benefit. That one has some real math behind it that most people never see. I'll see you then.